Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community. I'm Nathan Stovall, and on this episode, we're talking about how the pandemic altered the life insurance, wealth management, and commercial real estate business, and wanted to discuss what the path forward looks like, particularly in the face of higher interest rates. The pandemic created strong growth opportunities for traditional players in the life insurance space, but also brought some digital-focused disruptors. And of course, it altered the view of commercial real estate, in particular, office space, as many of us work from home. Joining us on the show to talk about how those trends have played out and where they see them going is the CFO of one of the most important players in the sector. With me today is Mike Carter, Executive Vice President, CFO, and Chief Risk Officer of Northwestern Mutual. Mike, thanks for coming on the show.
Glad to be here, Nathan. Thank you for asking.
So I wanted to start with the strong growth that we saw over much of the pandemic, and Northwestern Mutual really led the industry from a sales standpoint. What do you really think drove that growth? Was it taking advantage of a change in tax law, the product mix the company has, the nature of your distribution, or maybe a little bit of all three?
After a great year, I think companies ask themselves, was there something about us that we uniquely attributed to our business that caused that, or was it a rising tide lift all boats type of moment? And it's clear in the financial services industry that sales of life insurance increased as people thought about their own mortality. Clearly, COVID got folks thinking about mortality and whether or not they were adequately protected against COVID or really anything else. And you really saw that play out in the numbers for industry. So individual life insurance policies, I think, grew 20% on average industry-wide. And that, you have to go back to the early 80s before you saw that type of growth. So clearly something was going on. When we look at Northwestern Mutual, though, we saw growth that was significantly outpacing our competitors. Our life insurance sales grew by 52%. It was to a record level. We had never reached $1 billion in permanent life insurance sales in a year, and it was great. Our retail investment business also accelerated, increasing assets by 25%. So when you look at Northwestern Mutual today, we have a combined $570 billion invested, and that includes both our company and client assets. So then when we look at it, the question our board has certainly asked us, what's happening? What's the difference between the industry and Northwestern Mutual? And we think it's because more people want to work with us because we have integrated a financial plan and a trusted advisor. And we think that neither by itself is good enough. And so it's a combination of those two. And I should clarify what I mean by a financial plan, because everybody does planning. You can't walk across the street and not trip on somebody saying that they provide planning. But I think that what we provide is really unique. It's a comprehensive plan that combines permanent life insurance, annuities with investments, a holistic approach. And E&Y looked at this and they said, if you actually combine in the same entity both investment and insurance, tend to get better results for the client by doing that. And so, what we're offering, I think, resonates with people. And you could just look at our persistency. This year and last year, we reached an all-time high in persistency. Those are people choosing to keep their life insurance products with us to over 97%. That's an all-time record in 165 years of Northwestern Mutual. We've never had better persistency than that. Folks also want financial strength. Sometimes I'm surprised that people will entrust either their insurance or their investments with firms that just don't have a lot of financial strength, don't have a lot going to them. Smaller entities, sometimes on the wealth side. I just don't get that. Northwestern Mutual, we have the highest available financial strength ratings awarded to any U.S. life insurance and have a stable outlook with all four of the major rating agencies. So that'd be AM Best, Fitch, Moody's, and S&P. And just looking at Moody's, we're only one of 6 companies in any industry that have AAA and stable outlook. And so I think if you just look at that financial strength, we're the company that people want to do business with. Our mutual structure, I think, helps too. We don't have to do quarterly shenanigans to try to reach any particular result. We just play for the long term, try to see what's in the best long interest of the policy owners, and we deliver that year in and year figure out. Folks also want, I think, excellent customer experience. In the past, I think you could compete just on delivering great products. If you had the best product value, you could just say, hey, our products outperform others in the industry, and that would be enough. I don't think that's going to play in the future. It's not going to be enough anymore. You also have to have that superior customer experience. And if you don't, you're going to risk losing relevance in the market. So I think we've been on top of that. And the way that we really focused on it, one of the primary ways we focused on it, is our planning platform we like to call PX. It's an award-winning. If you ever get a chance to look at it, it stands out. It combines risk and investment products. It allows our financial advisors to show clients about, hey, here's how an integrated plan works. Here's how they come together, and they're going to provide you with more protection, growth, and flexibility any other way. So looking forward, I think the financial strength that we have, it allows us to do some things that we feel really excited about. One is we're going to continue to invest in what's our key competitive advantage, our financial advisors. People talk about at some point replacing financial advisors with some kind of automated approach, some kind of system. We just don't believe that's going to work for the long term. So we did during this pandemic, we focused on the financial advisor. We tried to invest in their technology. And right now it's the biggest, strongest, most diverse, and productive field force we've ever had. We saw a 20% increase financial reps since the start of 2020. Really the best recruiting time, ironically, in the company's history. We're going to continue to strengthen our client experience. I already talked about PX, our planning platform. I think you're going to continue to see that as excellent, and we'll continue to look at ways to improve that in the future. And something I haven't talked about, which I think is really important, is continue to accelerate and simplify Northwestern Mutual's underwriting process. If you've ever had a life insurance policy issued, you may have to have a paramed, give blood, urine, whatever, long process, lots of paperwork, and then a decision might come weeks, months later. That's just not going to fly in this world. We're actually leveraging artificial intelligence to automate many of these type of decisions, and we're going to do faster underwriting decisions for our prospective clients. By next year end, we are looking to automate over 60% of the policy applications we receive. No fluids, just straight through processing, get a result, not weeks, not months, but in hours. And so I think that's something that's going to be really impactful for our client base.
So you definitely had a lot of people looking to the industry, as you started off saying, but between offering trust, the holistic approach, strength, and also call it more concierge service through your advisor network, you really feel like you were able to drive that sort of huge outperformance, almost 2x growth. And it sounds like you feel like it's still there today. And one of the things that I mentioned at the opening is that we've seen insurtech move into the space, digital disruptors, but you just sort of spoke to at the end that the company is planning to invest heavily there. And I think the number you threw out was 60% of it automated in terms of products. Does that feel like you can easily remain competitive as you see more products move to that digital push? And or maybe not even or, would it make sense to partner with one of those companies or bring them aboard through an acquisition to help sort of speed up that process, particularly as we've seen some of them kind of go on sale?
Sure. So, certainly consumer expectations are growing, changing, and it's critical for us and every company to try to innovate. You may not get to the speed of Google or Amazon, but you have to try, or as I said, you're going to risk your relevance. And the insurtech market, we stay on top of that. We watch it. We know what's going on. We know what they offer and the capabilities that they provide, and much of that's very interesting. So nothing I'm going to say is going to say that we're not really on top of that. But for us, it's critical to tie the innovation to the strategy. So a lot of what you see isn't really tied to our strategy. I talked about our financial advisors. That's a key competitive advantage for us, and a lot of times that would not be compatible with insurtech sort of value proposition. So we're really key that we don't want to innovate for the sake of innovation. We want to make strategic investments in customer experience, the field, the value proposition, and the business. So I think, in short, we're going to continue to transform. We're going to stay relevant in this world, but we're going to do it on our terms. We're certainly embracing digital, focusing on customer service, helping people have an always-on financial plan that they can access on any device. So that's key for us. But just sort of following the path of insurtech companies, we don't believe that's in our best interest and not consistent with our strategy.
Right. Improving the customer experience and arming your FAs to work with them rather than try to go to some sort of digital-only kind of product.
Absolutely.
I want to shift to the rate environment and how that could change things for the company or whether or not you think it does. Do you think it gives you more opportunities to bring in new clients, the fact that we have higher rates again that we were waiting years for, and even though we had a tightening cycle in 17 and 19, it didn't look like this. Does that bring more opportunities to attract new clients and possibly introduce new products? And sort of bolt on to that is that, do you think it kind of positions you even more strongly against other financial institutions, including some of the largest banks who have been pretty hesitant to raise rates on, call it sort of their more traditional deposit products?
Yeah, I would start by saying higher rates certainly benefit us and all other large institutional investors. Northwestern Mutual, a significant portion of our general account, say 90%, is invested in fixed income-like instruments. We actually have $2 billion of net investable cash flow per month. And where's that going today? That's going largely into fixed income, higher yielding investments. Over time, as a mutual company, all our profits go to the policyholders. So we're going to generate more net investment income that will benefit our ability to pay dividends to policyholders. So no question, we're excited about the higher interest rate environment. What's that going to do for our policies over the long run? I said as a mutual company, again, we're doing what's in the long-term best interest. We don't have that public company traded mindset that we have to worry about. So we look at our products. Most of our products are actually going to do better under this higher interest rate. So we don't need to, let's say our permanent life insurance product, we don't need to change that product to pass on the benefits, the higher interest rates to our policyholders. They're going to get that. But in our designing products and setting pricing and making decisions, really we start what's in the best long-term interest of our clients and try to deliver that. So internally we feel very, very good about the higher interest rate environment and know that it's a good thing for Northwestern Mutual and its policy owners.
And it sounds like you're saying that, rather than needing to reinvent anything, not to say that you're not focused on innovation, that the benefits of higher rates just get passed on to clients. And I know you didn't quite go here, but relative to a public company who might be concerned about the cost of passing on that benefits, which I kind of alluded to. We've been hesitant to see it sort of bank land. You're not constrained as much. Do you think that kind of offers you a competitive advantage to continue to take market share or even retain some of your clients?
I think the singular interest focus on the policy owner, and I'll say it's true for Northwestern Mutual, but it's true for our other mutual peers, it's a huge competitive advantage. We don't have to think about what goes to the shareholder, what goes to the policyholder. They're one and the same. And so our decision making is different because we can focus on that policy owner. So, and that goes for everything I just said. We wouldn't issue a product that might look good in today's environment that would actually be harmful to policyholders over the long term. So I think it is a competitive advantage being a mutual, and certainly Northwestern Mutual is the strongest mutual, and so I think that's certainly a competitive advantage.
We spend a lot of time talking about rate risk, and it depends on the institution. But I mean, is there any worrisome sign about the quick move in rates from your perspective in terms of, or any challenges that come with operating with that? Sort of obviously that you have to manage against that. But as you sit in your chair and sort of see the swift move that we've had, how does that change operations, or does it, relative to maybe call it a slower rate environment like what we saw 5 years ago?
Yeah, I think that given the choice, we'd rather have a slowly growing rate environment. We look at sales at some point from the life insurance The dividend interest rate now is 5%. If new money rates got above that, our financial advisors would still sell through the plan because people need the protection that offers for their financial security. But would that be a factor potentially? Sure. As rates rise, our dividend and interest rate will rise along with the performance of the investment portfolio. So if anything, that'd be a short-term situation. We've certainly seen that before. From an inflationary standpoint, which comes along with the rising rates, really the impact to us, the vast majority of our liabilities are fixed. Where you see a little bit is on our goods and services that we provide, so our home office budget, and you see some impact on that. But again, it's not material compared to the size and strength of the company.
Right. Sure. Good time to be big with things like that and be able to take a long-term view. No doubt about it. I want to switch sort of outside of the life insurance space and talk a little bit about commercial real estate. Northwestern Mutual has been a notable lender in the CRE space, particularly in Class A office. How do you think about sort of return to office and lending into that sector? We had, of course, big fears early, and then we've had a big bounce back, and now it feels like everybody's sort of still in wait and see. You know, how are you thinking about it? What are you seeing in terms of that asset class?
Yeah, it's a question that we get quite a bit. Northwestern Mutual exposure to office real estate, which is where I think the most of the focus is in the office space because of the back to work and some questions about that. I mean, it's relatively modest. 18% of our exposure in our mortgage portfolio relates to office, and just 11% in our real estate equity portfolio. There's not one size fits all. Sometimes people want to just generalize across the country, and that's not our experience. It depends what market are you in, what sub-market are you in, what's the particular building, and it will vary depending upon that. So, for example, in Atlanta, office utilization is better than, let's say, San Francisco. But even if you take San Francisco, you look at a particular building, if it's got a water city view, higher floors, that tends to do better than other. So I think while the commodity office space in every market is challenged, we actually feel pretty good about the exposure that we have. We're really disciplined in our office investment strategy. And while the office sector certainly will be challenged, we feel good about our office portfolio. And real estate itself, you know, if you look at that, that's like a piece of it, but there's so many other pieces of our portfolio that's doing really good in inflationary conditions. So if you look at it, apartments, one of our best property types from an inflation hedging perspective. Half of our real estate equity portfolio is apartments and manufactured housing. So we're feeling really good about that. And then the second most competitive property is industrial. About a third of our real estate equity portfolio, and so that's doing really well too. And then you got to keep in mind that we have a huge investment portfolio across Old General Account, real estate, and others. You know, $300 billion general account portfolio. So there's a whole bunch of other great things in there: investment grade corporate bonds, mortgage loans, more. And so I just think we feel really good about. Hey, we do have exposure to real estate, which we want. Some of that's in office. We're pretty upbeat on what we have in that. You know, we're investing for the long term and think we're going to continue to provide superior returns to the policy owners.
Yeah, it's interesting on the apartment side. I mean, one of the things that I continue to see is that rents still are more affordable than a lot of mortgages still, though we're seeing some slowdown in housing now. But I mean, it's that part of what's playing out that's kind of giving you continued comfort, strength in that piece of the portfolio?
Yeah, if you have Class A apartment space in desirable locations in cities that are really growing, that's performed really, really well for us. People want to be in there. We're providing a experience with more amenities, and I think that's what's really drawing a lot of people to them. And so we couldn't, with the apartments real estate, we couldn't be more pleased with how that's performing, and we think that that's going to continue to grow in the coming years, despite whatever downturns there are.
Shifting back to office, specifically your office, I believe you built a new headquarters right before the pandemic began. Are you back in the office, and sort of how is the company looking at remote work as everybody's kind of testing different ideas out there?
There's no one size fits all on this. Talking to my peers at other companies, everybody's trying to wait it out, see what happens. For us, what we say is, hey, the majority of our employees should be on campus in a hybrid model, say 3 days in the office, 2 days remote. We think that provides flexibility, and that may change based upon role, team, and sort of individual commitments. You know, if you look at the way Northwestern Mutual and over our 165-year history, we have a long-standing relationship-based culture. So really the word I'd focus is on culture. We encourage time on our campus for meetings, teaming, and lunching. It's really what's made our company successful so many years, and I think we continue to be better for it. So that employees sometimes will point out, well, the last couple of years we've been as productive as we ever have been working remotely, and I think that's true. I think the worry is more on the long-term impacts to the culture from a fully remote workplace. You talked about the new headquarters building. I don't know if you've ever seen it. It's a beautiful building, and that's been really well received by employees, and it's part of the overall value proposition for employees coming back into the office. So I think for us it's about culture, not about productivity, and we think that as time goes on, more and more of our employees will choose to be back in the office, to be with their coworkers, to be in the beautiful campus environment that we have here and all the amenities that we provide.
Yeah, one of the things I've heard people say that I just think makes a lot of sense is, particularly in that sort of environment, not only is it important to create a culture, and that's how you do it, but also with people who are more junior and starting off in their careers, they're able to learn from the more tenured veteran employees. And that experience is really hard to do that in a remote space.
I think you're absolutely right. The thought that I could have come in this company 28 years ago and really learned the business and learned different roles and sort of ascend to the CFO and CRO role, I just don't see that happening if I hadn't had the mentors, the discussions, the lunches, talk about career advice, talk about skill sets, what I should do to work on and improve. So I think you're right. It's the newer people. They should want to be on campus, because I think that gives them the best opportunity for success.
Just lastly, real quick in closing, calling back, similar topic, but something you said right at the outset, that you had a record recruitment year in terms of hiring new talent. Do you think the culture you're talking about and sort of the long-term view and holistic approach, is that what drove that? How were you able to do that? Because one of the things we talk a lot about is it's hard to hire right now. You know, there's not as many people in the labor force. So how were you able to do that?
So I think I was talking about the field force specifically. We've had tremendous on the home office side, but if you're talking about the field force, you know, we really focus on diversity and inclusion. And if you look at that growth that I was talking about, women and people of color account for 75% of our full-time advisor growth. And we look at those with management contracts. Those have increased 62% for women and 53% of people of color. You just look at the 22 advisory recruits, nearly 50% of them were women and people in color. So I think our focus on being more diverse, that's a strategy of growth. It's a growth strategy. And by the way, it will pay dividends in sales for decades to come by getting a more diverse. Yes, you can increase recruiting when you look beyond your maybe target pool from a decade ago, but the diversity is leading to growth, and it's going to lead to better company results. We'll be a bigger, better, stronger company because of it.
No doubt about it. Well, I think that's a great place for us to leave it. Mike, thank you so much for coming on the show.
Nathan, I really appreciate the opportunity. Have a good day.